For millions of Canadian homeowners, there's a hidden tax that's draining wealth from them every month when they pay their mortgage. There's a solution to that hidden drain, and that's the Smith maneuver. And it's incredibly effective. In fact, it's the most powerful strategy available to Canadian homeowners currently. But you need to be the right fit for the Smith maneuver. If you're not, it can actually accelerate your wealth in the wrong direction. So in this video, I'm going to go over the 3 key metrics that you can measure yourself against in your situation to find out if the Smith maneuver is right for you and whether you should seriously consider looking into implementing it. So let's jump in. The very first thing that we need to talk about is your personality fit. So let's see if you are a personality fit for the Smith maneuver. And within this, there are 3 key things that we need to consider. First off is debt. Are you comfortable with debt? Now, if you're watching this video, you presumably already have a mortgage. So you're comfortable with a certain amount of debt. In fact, probably a lot of debt if you're a Canadian homeowner. With the Smith maneuver, the goal is that your debt remains stagnant, remains the same. So Canadians historically have been used to paying down their mortgage month over month and watching the number decrease. In the Smith maneuver, we're not going to allow that to happen. We're going to continue to use that debt. Now, if that's going to keep you up at night, that's a red flag for the strategy. So that's number 1 is debt. Number 2 is volatility. Volatility. Even the best investors are going to experience downturns in the market as they eventually go up. If you are comfortable only on the ups, but when it gets down, you're going to start losing sleep again, this may not be a good strategy for you. The downs are an essential part of growing. It's going to always happen, even to the best investors. So if when it gets here, you think you're going to panic and sell, or here, even if your total holdings is underwater, in the Smith maneuver, it's a long-term game. So we're talking about being comfortable through all that volatility. That's number 2. And number 3 is discipline. Now, what do I mean by discipline? I just mentioned that Smith maneuver is a long-term game. In discipline, you need to be able to exercise the right moves with your borrowed money every single time. You can't be using the borrowed funds for a kitchen renovation or a vacation or a new car. The discipline required is that you're going to use the funds exactly for what they're meant for every single time for the full amount of time of the strategy. Now, if you answered no to being comfortable with any of these things, you're going to be grouped in with what's called the conservative homeowner. Now, there's nothing wrong with being a conservative homeowner, but if you are that, you're not comfortable with debt, you're not comfortable with volatility, and you're maybe not the most disciplined with your money, this strategy is probably not a good fit for you. So you can probably stop watching the video now, but if you said you're comfortable with these things and you want to find out if you're a fit in other areas, let's move on to the next thing, which is financial fit. Let's talk about it. Financial fit. There we go. Okay. Like in personality fit, in financial fit, there's 3 main things. The first thing we're going to talk about, number 1, is equity. This is essential because in the Smith maneuver, you need to have a certain amount of equity in order to implement the strategy. So here is your home's value, top to bottom. So let's say it's worth 1 million. In this case, 1 million. This is $0 down here. That's your debt. So if your house is worth 1 million, the maximum amount of loan that you can have in the strategy is 800,000. 800,000. So that means that your loan to value is 80%. At that level, you can use the strategy very effectively. The ideal level where you can implement the strategy at the highest possible level is at the 65% loan to value. So in a $1 million house, that would be $65,000 worth of debt or less. That's when you can implement the strategy to the maximum potential. So if you are a homeowner that's just purchased a house with only 5% down, your loan to value is going to be 95%. That's way too high for this strategy, so you're not ready to implement the strategy yet. The second thing is credit. Now, with the Smith maneuver, you need to have a decent amount of good credit in order to be able to qualify for the products that you need. The Smith maneuver requires a specialized mortgage, not that specialized, it's offered quite often, but it's called a readvanceable HELOC mortgage. And so that means when you pay down your mortgage a little bit, your room in your HELOC to borrow opens up. You don't lose the amount that you've paid down, you gain it in a different way that's free until you use it. So you need to have good credit and good income and good standing in order to implement that. And number 3 is tax bracket. If you are a very low income earner, chances are you'll have a hard time having a house in Canada if you're super low income earner. But if you manage to acquire a house and you're low income earner in a really low tax bracket, this strategy is going to be less effective for you. This strategy focuses on taking the tax deductions that you're going to get and applying it in a beneficial way. If your tax bracket's already very low, the benefits of this strategy are going to be reduced just because you can only reduce it by the amount of your tax bracket. So that is a third thing. So if you are someone that has a more than 80% loan to value mortgage, or your credit is poor, or you don't have very much good standing with the banks, or you're in an extremely low tax bracket, we're going to call you a foundation builder. Now, this is different from the conservative homeowner. Conservative homeowners are likely never going to be a fit for the strategy. A foundation builder just means that we have some time to work out some of the kinks with the strategy. Equity will be reduced, credit can be improved, income can always increase. So we want to make sure we're working towards those things. If you're in this group, I recommend you stick around for the last section so that you know all the qualifications, and that's going to be the timeline fit. So let's jump into that. Now that we know that you're a personality fit, you're a financial fit, or could be soon, let's talk about timeline fit. Timeline fit. Now, most mortgages start at 25 to 30 years. So let's just make up some markers here. 5, 10, 15, 20, 25, 30. Let's go. So this is 0 years remaining on your mortgage, 5, 10, 15, 20, 25, and then 30 in some cases. Okay. If you do not have a long time horizon when you're implementing the Smith maneuver, you may as well just skip it. Anywhere in this zone, 0 to 5 years remaining on your mortgage or 0 to 5 years commitment to the strategy, don't bother. The whole point of the strategy is that it's going to start compounding results. That means that you're going to get the best benefits at the end of the strategy. Also, we talked earlier about volatility. Within the 5 years, you might actually be below or underwater in your investments. And that only sorts itself out with the long time horizon. So if you're thinking 0 to 5 years, focus on paying down your mortgage or building your income. That's a better way to do things for you. If you're 5 to 10 years, you're okay. It's the very shortest amount of time I would recommend for the strategy. And if you're anywhere 10 to 30 years, that is the ideal. The longer the time horizon, the better. In fact, we often do a calculation where we see if it's worth breaking your mortgage or staying with your mortgage right now. And even a year or two difference can make a difference of hundreds of thousands of dollars in the end, because with compounding, the growth does that. It skyrockets at the end. So if you cut yourself a year or 2 years short, you're at a hugely different valuation of your portfolio than you would have been if you carried on for the entire length. And so time and amount of time in the strategy is really, really important. If you're still here, you are an excellent candidate for Smith Maneuver. You're a personality fit, you're a financial fit, and you're a timeline fit. I'm going to put a link in the description below where you can book a call directly with me to go over your numbers. You owe it to yourself to see what kind of benefit Smith Maneuver can do for you. So do that right now and book a call today.